All right, today we're putting Carrier Global Corporation under the microscope for a full financial checkup. The big question is this industrial giant actually in good health? Let's dig in and find out. Okay, let's kick things off with a number that really sets the stage. Almost $51 billion. That's Carrier's market cap. Basically, it's the total price tag the stock market has slapped on the company. It gives us a great sense of scale before we get into the nitty-gritty. So to get a really clear picture here, we're going to treat this just like a medical exam. We'll start with its price tag, its valuation. Then we'll check its performance. After that, we'll see how it treats its shareholders, peek under the hood at its financial foundation, and wrap it all up with our final diagnosis. First up, valuation. Really, this whole section boils down to one simple question. Is Carrier's stock a bargain right now, or is it on the expensive side? Let's figure that out. And one of the classic tools we use for this is the PE ratio. That's price to earnings. Honestly, the easiest way to think about it is just as a price tag. It tells you exactly how much investors are willing to fork over for every single dollar of the company's profit. Okay, so Carrier's PE ratio right now is 35.65. But a number like that floating in space doesn't mean much, does it? Is that high, low? To make any sense of it, we absolutely need some context. And boom, here's that context. When you look at its own history, this PE is, well, it's high. The company's 3-year average was just a little over 22. Today, it's trading at a 60% premium to that. Wow. That tells you the market has gotten way more optimistic about Carrier's future. All right, so let's see if the company's actual performance backs up that high price tag. Usually, a high valuation like that needs some serious growth to justify it. So let's pop the hood and check the engine room, see what's really going on with sales and profits. And right away, things get interesting. We've got a bit of a puzzle on our hands. See, over the last 3 years, Carrier sales have been growing, a little, which is good, but at the exact same time, its net income, we're talking bottom line profit, has been shrinking. And not by a little, by a whopping 25% a year on average. So more money's coming in the door, but less is actually sticking around as profit. So that split right there raises a super important question. Remember, net income is what the accountants say. But cash is king. If those reported profits are falling off a cliff, what's happening with the actual, real-world cash the business is generating every day? And here we go. This is the other side of that coin. Check this out. Despite that 25% annual drop in profit, the company's free cash flow, that's the real cash left over after running the business, has been growing by a really healthy 15% per year. So why the difference? Well, it's because net income includes all these non-cash expenses like depreciation. Free cash flow just looks at the cold, hard cash. And that tells us something huge. The underlying business is a cash-generating machine, even if the accounting profits look weak. Okay, and that strong cash flow is the perfect lead-in to our next stop, shareholder returns. I mean, with all that cash coming in, how is Carrier rewarding the people who actually own the company? Let's take a look at the dividend. And the dividend story here really screams confidence and stability. For starters, the company has jacked up its dividend for 6 straight years. Not only that, but it's been growing at an average of over 9% for the past 3. The payout ratio is sitting at about 53%, which is a really sweet spot. It means they're paying out about half their earnings, which leaves plenty of cash to reinvest and grow the business. Okay, so let's recap where we are. We've got a pricey stock, a kind of weird profit situation, but awesome cash flow, and a solid dividend. Now it's time to really get under the hood and check the company's core financial stability. Bottom line, can it pay its bills? The way we measure this is with a concept called liquidity. Sounds fancy, but it's actually a super simple question. Does the company have enough cash, or stuff it can sell for cash quickly, to cover all its short-term bills? So their current ratio is 1.20. Let me break that down. For every single dollar in bills they have to pay soon, Carrier has $1.20 in assets to cover it. Pretty solid. Then there's the quick ratio, which is an even tougher test, because it ignores inventory. That one's a little lower at 0.85. But when you put them together, these numbers tell you the company is in a pretty darn good position to handle its immediate bills. And what about the long-term picture? Well, its debt-to-equity ratio is 0.86. Now, anytime you see ratio below 1, that's generally a good sign. It points to a more conservative financial setup. It basically means Carrier is using more of its own money rather than borrowed money to run the show. All right, we've done the full workup.
We've looked at the price tag, the performance, how they reward shareholders, and the financial foundation. So after this complete checkup, what's the final diagnosis for Carrier Global?
Our diagnosis really reveals a company of contrasts. On one hand, the stock looks expensive, and its reported profits have been taking a hit. But that's balanced out by some seriously strong and growing cash generation. Plus, it's a company that consistently rewards its shareholders with a growing dividend. And all of that is built on a really solid financial foundation with debt that looks totally manageable. So this whole checkup on Carrier really leaves us with a fundamental investing question, doesn't it? When you're looking at a company that has these kinds of contrasts, a high price tag today, but really strong underlying cash flow, how do you balance that? How do you weigh the price you have to pay right now against what you think its potential is for tomorrow?